Section 4b, Importance of Cash Flow Analysis. Cash flow projections play a vital role in cash management, resource allocation, and risk assessment within a company. Here's how cash flow projections assist in these areas. Cash management. Cash flow projections help in effective cash management by providing insights into future cash inflows and outflows. By projecting cash flows, decision-makers can monitor cash position. Cash flow projections allow decision-makers to anticipate periods of cash surplus or cash shortage. This enables them to proactively manage the company's cash position, ensuring that there is sufficient cash available to meet financial obligations and cover operational expenses. Plan cash reserves. Cash flow projections help determine the ideal level of cash reserves to maintain. By anticipating future cash flows, decision-makers can identify periods of low cash flow and allocate resources to build up cash reserves, providing a cushion for unforeseen expenses or economic downturns. Optimize cash conversion cycle. Cash flow projections enable decision-makers to identify opportunities for improving the cash conversion cycle, which refers to the time it takes to convert investments in inventory and receivables into cash. By analyzing projected cash flows, decision-makers can implement strategies to reduce inventory holding periods, accelerate customer collections, and optimize payment terms with suppliers, thereby freeing up cash for other uses. Resource allocation. Cash flow projections assist in effective resource allocation by providing visibility into the availability of cash for various uses. By projecting cash flows, decision-makers can allocate capital expenditures. Cash flow projections help in planning and prioritizing capital expenditures. Decision-makers can assess the timing and magnitude of cash outflows required for investments in new projects, equipment, or technology, ensuring that funds are allocated appropriately and aligned with the company's strategic objectives. Evaluate growth opportunities. Cash flow projections aid in evaluating growth opportunities, such as acquisitions, partnerships, or market expansions. By assessing the impact of these initiatives on cash flows, decision-makers can determine if the company has the necessary cash resources to pursue these opportunities or if external financing is required. Assess investment returns. Cash flow projections assist in evaluating the potential returns on investment. Decision-makers can compare projected cash inflows with the cash outflows associated with investment opportunities, helping them make informed decisions about resource allocation and choose investments that generate positive cash flows and add value to the company. Risk assessment. Cash flow projections facilitate risk assessment by providing a basis for evaluating the company's financial resilience and vulnerability to potential risks. By analyzing cash flow projections, decision-makers can identify cash flow risks. Cash flow projections help identify potential risks that could impact the company's cash flows, such as changes in market conditions, customer behavior, or regulatory factors. Decision-makers can assess the potential impact of these risks on cash flows and develop contingency plans to mitigate their effects. Conduct stress testing. Cash flow projections enable decision-makers to conduct stress tests by simulating adverse scenarios and assessing the resilience of cash flows under challenging conditions. This helps in identifying potential vulnerabilities and strengthening the company's ability to withstand financial shocks. Evaluate risk-return trade-offs. Cash flow projections assist in evaluating risk-return trade-offs for different strategic initiatives. Decision-makers can assess the potential impact of risks on cash flows and weigh them against the expected returns, enabling them to make informed decisions about risk appetite and prioritize investments or actions accordingly. By utilizing cash flow projections, decision-makers can effectively manage cash, allocate resources optimally, and assess the company's resilience to various risks. It enhances the company's financial stability, supports strategic decision-making, and ensures the efficient use of available resources.